These two reports are among the most powerful stock catalysts in the entire market. The 10Q quarterly report and the 10K annual report. Most beginners see these and have no idea what to do with them. Today, we break down exactly what they mean, what numbers to look for, and the timing strategy most traders never learn.
The 10Q is a quarterly report filed with the SEC every 3 months. It reports the company's financial performance for that quarter, revenue, earnings, expenses, and guidance for the next quarter. This is one of the most powerful stock catalysts in the market, filed within 40 to 45 days after the quarter ends. The 10K is the annual report filed once a year. The full picture, full-year revenue, profitability, debt, cash flow, and risk factors. More comprehensive than the 10Q. Essential for understanding whether a company is worth holding long-term. Where to find them? SEC Edgar at sec.gov. Search the ticker and filter by 10Q or 10K. Also on Webull phone app. Go to the News tab, then to the Press Release section. Both completely free. And here is the honest truth. You do not need to read the entire report. Focus on the key numbers and whether they beat or missed analyst expectations. That is what moves the stock price.
The two numbers that move stock prices after an earnings report. EPS, earnings per share. This is how everyone judges a stock's profitability. EPS tells you how much profit the company made per share of stock. If EPS beats analyst expectations, that is generally bullish. If it misses, that is generally bearish. Revenue, the total income the company generated that quarter. Revenue growth shows the business is expanding. Revenue decline raises serious questions about the company's health. And do not forget guidance. What management says about the next quarter can matter more than the current results. Strong guidance can offset a miss. Weak guidance can tank a stock price. The bottom line, beat expectations on EPS and revenue with strong guidance. That is a bullish setup. Miss on either with weak guidance, expect selling pressure.
Here is the earnings timing playbook most traders never learn. Most quarterly reports drop after market close. The stock may run in after hours trading, but this is often not the real move. Smart money is already positioned. If a stock releases its earnings report pre-market and beats expectations, expect it to run hard before the market opens. But here is the trap most traders miss. Once regular trading hours begin, that same stock often reverses and sells off hard. The pre-market move already priced in the good news. By the time retail traders react, the smart money is already selling into them. Retail buyers chase the pre-market move and get trapped when it reverses. This happens consistently. And here is the warning every trader needs to hear. Even when a company reports strong earnings, beating every estimate on the board, the stock can still tank. The market does not just react to how good the earnings were. It reacts to whether the earnings were good enough compared to what investors were already expecting. If expectations were too high going in, even a strong report can disappoint. This is called selling the news, and it catches new traders off guard every single earnings season. The genuine, sustained move usually comes the next day after the dust settles. Once the initial excitement and selling pressure clears, that is when the real direction reveals itself. And here is the setup worth watching, a stock that beats expectations and then dips. That dip is often a genuine buying opportunity. The beat was real, the dip is just short-term noise and profit-taking. Beat plus dip equals potential entry. If this free education is helping, hit like, share, and subscribe right now. Follow Alpha Breakout Lab for free stock alerts every week.
Here's a real example of the earnings timing playbook in action, AEHR, Air Test Systems. The quarterly report was approaching. The key was watching whether EPS and revenue would meet analyst expectations. The chart was already set up technically. Support was holding and the moving averages were positioning for a potential move. When the report met analyst expectations, the price movement played out exactly as anticipated, including the timing of the initial reaction and the subsequent run. The earnings timing playbook applied precisely. What made it work? Combining chart analysis with earnings timing knowledge. The technical setup confirmed the opportunity. The earnings timing playbook confirmed when to watch for the entry. Both tools working together gave a much higher probability setup than either one alone. Honest disclaimer, this is a personal documented observation. Past price movements do not predict future results. Always use stop losses and never risk more than you can afford to lose.
That is the 10Q and 10K, what they mean, what to look for, and how to time the move. EPS and revenue, beat or miss. Pre-market run, expect the tank. Real move next day. Beat plus dip, potential opportunity. Part 3 drops next week, Form 8K, the filing that moves stocks immediately. Like this video if it helped. Subscribe so you do not miss Part 3. Follow Alpha Breakout Lab for free stock alerts every week. Builders do not sleep until the dream is real.